Tilray just beat the market. And I know what you're thinking. Wait, isn't that the cannabis stock that's down like 95% from its highs? Yes, same company. But here's what nobody's talking about. Over recent trading periods, TLRY delivered returns that exceeded major market benchmarks. The question isn't whether it happened. The question is whether it means anything, or if this is the setup for another brutal disappointment. Stick with me for the next 7 minutes, because I'm going to show you exactly what's driving this move, why Wall Street is quietly repositioning, and the 3 critical factors that will determine if Tilray is finally a buy or the same trap it's been for years. Let's get into it. First, let's talk about what's actually behind these returns. Because outperforming the market means nothing without context. Tilray didn't beat the S&P because cannabis suddenly became legal everywhere. They beat it because of something far more calculated. Tilray has been on an aggressive diversification tear. They're not just a cannabis company anymore. They own craft beer brands like Sweetwater. They acquired Montauk Brewing. They bought Anheuser-Busch's craft beer portfolio. Read that again. They bought brands from Anheuser-Busch. This isn't a weed company hoping legalization saves them. This is a beverage and CPG company with cannabis exposure. And that distinction matters enormously for institutional investors who can't touch pure-play cannabis stocks. Now here's where it gets interesting. Tilray's CEO, Irwin Simon, and pay attention to this, came from Hain Celestial, the organic food giant. This guy doesn't think like a cannabis executive. He thinks like a consumer packaged goods operator. And that strategic lens is reshaping what Tilray actually is. Their revenue mix tells the story. Cannabis is now roughly 40% of their business. Beverage alcohol, wellness products, and distribution make up the rest. They're building a portfolio that can survive and thrive regardless of what happens with federal legalization. But here's the pattern interrupt you need. Stop thinking about Tilray as a cannabis bet. Start thinking about it as a regulatory arbitrage play. Here's what I mean. Tilray is positioning for 3 separate catalysts. First, German legalization. Already happened. Tilray has medical cannabis operations in Germany, and they're scaling fast. Second, U.S. rescheduling. The DEA is reviewing cannabis classification right now. A move from Schedule 1 to Schedule 3 wouldn't mean recreational legalization, but it would be massive for banking, taxes, and institutional investment. Third, beverage market consolidation. Big alcohol is circling cannabis-infused drinks. Tilray's already there with infrastructure. Any one of these catalysts hits, and TLRY reprices. All 3? We're talking about a fundamentally different valuation conversation. Now I have to give you the other side, because if I don't tell you the red flags, I'm not doing my job. Red flag number 1, dilution. Tilray has issued shares like they're printing money. The share count has exploded over the past 5 years. Every time the stock rallies, they dilute. Every acquisition, more shares. Your ownership percentage gets smaller constantly. This is not a company that respects shareholder equity. Red flag number 2, profitability remains elusive. Yes, they've improved adjusted EBITDA. Yes, they talk about being cash flow positive, but GAAP profitability, still not there. And in a higher interest rate environment, the market has zero patience for growth stories that can't show real earnings. Red flag number 3, the U.S. cannabis market is a mess. State-by-state legalization created a fragmented disaster. Prices collapsed. Operators are going bankrupt. Even if Tilray wants to enter the U.S. market aggressively, what are they buying into? Distressed assets in a broken system. So where does this leave us? Here's my framework for thinking about Tilray right now. This is an asymmetric bet with defined risks. The downside is probably another 30-40% if rescheduling fails and they keep diluting. The upside, if multiple catalysts hit, could be multiples of the current price. But you need to size this position accordingly. This is not a core holding. This is not a set-it-and-forget-it investment. This is a calculated speculation on regulatory change and strategic execution. The smart money isn't asking if Tilray is a good company. They're asking if the risk-reward at current prices makes sense given the catalyst timeline. And right now, with German operations ramping, rescheduling potentially months away, and a beverage portfolio providing downside protection, the setup is more interesting than it's been in years. That's the data. That's the framework. The decision is yours. If this analysis helped you think differently about TLR or any stock, hit subscribe. I drop videos like this every week, breaking down the investments Wall Street doesn't want you to understand. One click. That's it. I'll see you in the next one.